Imagine a massive ship, right, stuck in dry dock for years, and then finally the last huge barrier just gets removed.
Yeah, that sense of potential, like it's finally free to sail.
Exactly. That's kind of the feeling around a major financial institution right now.
It's definitely more than just a feeling. It feels like a truly pivotal moment for Wells Fargo, one of the biggest banks in the U.S. Something people have watched for a long time.
And that's what we're going to dig into today. We're unpacking Wells Fargo's second quarter 2025 results and, the huge news that regulatory asset cap is finally gone.
Right. We want to explore what this actually means
Mm.
for their finances, their strategy, and, well, how they plan to compete and contribute now.
We're pulling this straight from the horse's mouth, basically. Wells Fargo's Q2 2025 earnings call and their official results release. Both just out today, July 15th, 2025.
Your fresh data, it's all straight from them.
Okay, so let's cast off. The absolute biggest headline, the one everyone's talking about, is lifting that asset cap. Maybe just remind us, what was this cap? Why was it such a big deal?
We'll think of it like a strict limit, a hard ceiling, on the total size of Wells Fargo's balance sheet. It was put in place way back in 2018 by regulators,
Hmm.
and it basically stopped them from growing their assets beyond a certain point. This wasn't just, inconvenient. It fundamentally choked their ability to take on deposits, make loans, expand.
Right, and getting it lifted wasn't like flipping a switch, was it? This has been a long, tough journey for them.
Oh, absolutely not sudden. They called it a pivotal milestone in their transformation. And they pointed out this follows getting rid of 13 regulatory orders since 2019, 7 of those just this year.
Wow, 7 this year alone.
Yeah. Their message is basically, look, we did the really hard work, we've fixed things, and we're a far stronger company today because of it.
That sounds like a massive undertaking. I thought it was interesting, too, how they specifically mentioned their employees. All, 212,000 of them?
Yeah, that stood out. It shows the human side of this huge cleanup effort. They gave special cash awards the last 2 years to folks earning under $85,000, kind of acknowledging the grind.
Uh-huh.
And now, with the cap lifted, a special stock award for everyone. It's partly a thank you, but also, it seems, a way to give employees a stake in the future success, now that this major hurdle is gone.
Okay, so the barrier's down. How does this actually change their game plan? What can they do now that they couldn't before?
Well, the first big shift is just focus, where senior management spends their time. For years, it's been almost all about the risk and control agenda, fixing problems, meeting requirements.
Right, putting out fires.
Exactly.
Yeah.
Now, that focus on risk isn't going away. They say it's embedded now, but it's less all-consuming. So management can spend way more time on growth in the future. That's a huge strategic shift.
Yeah, moving from defense to offense, basically. And that must directly impact how they use their money, their capital. That's got to be a massive change.
It was one of the biggest things. Wells Fargo, they generate a lot of capital,
Yeah.
but they were effectively limited in how they could deploy it. They even said, look, shareholders got more buybacks, sure, but we would prefer to allocate more capital to grow our businesses and the overall balance sheet.
Right, reinvesting it.
Exactly. And now they have the flexibility to proactively grow deposits and put capital towards growing loans, growing their corporate and investment bank. So capital isn't just for returns anymore, it's for growth.
That's a major pivot. Can you give us some concrete examples? Like, what couldn't they do before and what's the plan now?
Sure. Take deposits. They were actually turning away deposits from corporate clients. Can you imagine? And being careful not to aggressively grow consumer deposits. A bank not wanting deposits.
Wild.
Now, they plan to be more aggressive in our pursuit of consumer and corporate deposits, actively going after what they had to push away.
Okay, and loans, core banking stuff.
Yeah. Crucial. They had to be cautious about loan commitments, especially when things felt uncertain, like early COVID. They just couldn't risk ballooning the balance sheet.
Makes sense.
Now, they say they will selectively look to grow loans. Still cautious, they mention, if the economy looks shaky, which seems sensible. But the option to grow is back on the table.
And their markets business.
Right, they'd constrained our markets-related balance sheet there, too, to save room elsewhere. Now they see chances to allocate more balance sheet to that area, trying to boost customer trading and financing, they say, without taking on a lot more risk.
It also sounds like the general regulatory climate is becoming maybe a bit more favorable for them, too, beyond just the cap.
It seems that way. They mentioned their expected stress capital buffer, the SCB, is set to drop significantly by 120 basis points.
Okay.
That lowers their minimum required capital ratio back down to 8.5% or maybe 8.6% depending on final rules. That's a huge decrease, especially after it went up the year before. Gives them even more flexibility.
And they sounded positive about the Fed's CCRR process, too, the big stress test review.
Yeah, they use the word encouraged about the Fed intending to provide more detail and transparency there. And they also said they support reviews of regulations that maybe go beyond safety and soundness and make it harder to serve customers, kind of hinting they'd like a more efficient regulatory environment.
Okay, so strategy's shifting, regulation looks maybe a bit better. Let's get down to the numbers. How did they actually do in Q2, even before this cap lift really kicks in?
Well, the Q2 results suggest things are already moving in the right direction financially. Net income was $5.5 billion. That's $1.60 per share.
Which is up from Q1 and last year.
Yep, up from both. So it suggests, consistent progress towards stronger profits.
And return on tangible common equity, ROTCE, that's always a key one for banks.
That hit 15.2%, also
Okay.
trending up nicely. But there's a little asterisk there.
Ah, okay. What's the catch?
It included a gain of about $253 million, or 6 cents a share, from buying the rest of their merchant services joint venture. So still strong, but that one-time item helped push it over 15%.
Got it. Important context. How did overall revenue look? Net interest income versus non-interest income.
Total revenue is $20.8 billion, give or take, up 3% from Q1, up 1% from last year. Net interest income, NII, that was up 2% from Q1.
What drove that?
Mostly lower deposit costs, an extra day in the quarter, higher yields on securities, a bit more in loans. But even with that sequential bump, it was still down 2% compared to a year ago. Shows you the pressure on net interest income.
Right, the rate environment. And
Yep.
the other side, non-interest income, often more volatile.
That was up a healthier 4% from last year. Main drivers were that merchant services gain we mentioned. Also, higher fees in wealth and investment management markets were good for asset values and higher investment banking fees too. So decent performance across different fee streams.
Expense control has been like a mantra for them for years. Did they keep that up?
Oh yeah, very disciplined. They made a point of saying headcount has now been reduced for 20 consecutive quarters.
20. That's 5 years straight.
Exactly, down 23% over 5 years. Non-interest expense was down 4% from Q1, partly seasonal, but the underlying efficiency push is definitely still there.
And credit quality.
Yeah.
Always crucial, especially with economic uncertainty floating around.
Performance looked really good. It actually improved. The net loan charge-off ratio went down from Q1 and from last year.
Yeah.
Losses improved in both consumer and commercial loans. So their loan book looks quite healthy right now.
That's reassuring. So with all this, what are they doing with their capital? Sounds like they have a lot. Big shareholder returns.
They definitely have the capacity. Their key capital ratio, CET1, is 11.1%, well above the minimum. They bought back $3 billion of stock in Q2 alone.
Okay.
That's over $6 billion in the first half of the year. And the board just authorized a new buyback program for up to $40 billion.
$40 billion?
Yeah, it's a massive number, a big signal. Plus, they expect to hike the dividend by 12.5% in Q3 to 45 cents a share, assuming the board approves. So yes, strong capital returns are happening.
Okay, let's pull back the curtain a bit on some specific business areas. What's happening in consumer banking and lending? Anything stand out?
Well, their credit card business seems to be really hitting its stride finally. They've put a lot of investment into new products, better customer experience.
It's working.
Apparently so.
Yeah.
J.D. Power ranked them number 2 for both mobile app and online credit card satisfaction. And they said that's driving new accounts, higher balances, more spending.
Interesting. What about auto loans? That's been a tough area for lots of lenders.
Yeah, but it looks like a turning point for Wells. They launched that big co-branded deal with VW and Audi.
Right.
And they saw strong originations in Q2. And get this, for the first time in over 3 years, their total auto loan balances actually grew. Suggests they're successfully getting back into that market.
That is a turnaround. And they're still working on the branch and digital experience, too.
Yeah, it's both. They're seeing growth in primary checking accounts, which they link to marketing, plus improvements online and in branches. They're refurbishing branches, aiming for half done by year-end, the whole network by 2028.
And still opening new ones.
Yeah, interestingly, they're expanding in places like Chicago, New York, Nashville. But digital is growing too. More accounts opened online, and active mobile users are up 4% year over year, over 32 million now. So they're playing offense on both fronts.
What about wealth management, serving the more affluent clients?
Good momentum there too, especially from their Wells Fargo Premier offering. They've hired more branch-based financial advisors, up over 10% from last year.
And that's driving flows.
Seems like it. Better collaboration, they said, drove over $16 billion in net asset flows into that premier channel. That's up over 60% year over year. And balances, both deposits and investments from those clients, are up around 10%.
Okay, switching gears to commercial banking. What's the focus there? Now they have more room to maneuver.
Well, the investments they've made in corporate and investment banking seem to be paying off. Investment banking fees were up 16% in the first half.
Gaining share.
Yeah, they said they've made steady progress gaining U.S. investment banking market share, especially in leveraged finance and M&A. And they're still hiring top talent, like their tech banking group grew its team by over 25% in the past year.
They were also simplifying things for a while, selling off non-core units. Is that still happening in commercial?
They just made what sounds like the last big move there. They agreed in Q2 to sell their rail equipment leasing business, expected to close early next year.
Okay.
And they specifically called it the last thing of any size they plan to sell. So that suggests the portfolio cleanup is pretty much done. Now it's about focusing on the core.
Let's zoom out again. What's their read on the overall economy? How are their customers holding up?
They sounded pretty positive, actually. Said the health of their clients has not changed, still strong. Low unemployment, inflation seems in check from their view.
Any weak spots?
Credit card spending growth softened just very slightly, but still up year over year, still strong overall. Debit card spending stayed strong and consistent, and consumer delinquencies actually kept improving. Commercial credit also holding up relatively strong.
What about trade? That's always complex. What are their commercial clients saying?
Yeah, that was interesting. It's a mixed bag. Many clients are apparently optimistic the administration is trying to level the trade playing field, and they seem to prioritize a good long-term outcome for U.S. trade over just short-term certainty. They've apparently found ways around the 10% tariffs so far, but there's definitely caution. They aren't aggressively building inventory or hiring. They're making backup plans.
Preparing for the downside.
Exactly. Wells Fargo kind of summarized it as, the market seems to expect good outcomes on trade, but there's still risk to the downside. Very pragmatic view from the ground level.
Okay, so looking forward, what's the financial game plan now the cap's gone? Let's start with net interest income, NII. What's the outlook for the full year?
Right now, they expect 2025 NII to be roughly in line with 2024's $47.7 billion.
Roughly in line. I thought maybe growth would pick up more.
Well, it's actually a bit lower than they hinted before. The main reason, they said, is they're choosing to put more balance sheet to our markets business.
Oh, okay.
And while that generates revenue, some of those assets don't earn much NII directly. The revenue shows up more in non-interest income. But they do still expect NII to grow quarter over quarter in Q3 and Q4 this year.
And loan growth. Are they planning a big ramp up now?
Not a huge surge, no. They're forecasting modest growth. Consumer loans like car and auto, commercial loans mainly from the corporate and investment bank side, that's for the second half.
Mortgage is still shrinking.
Yeah, they expect the residential mortgage book to keep declining slightly.
Yeah.
So overall loan growth for the year sounds relatively modest. They also flag that loan pricing, especially commercial, is still very competitive. Other banks are the main rivals there. So it sounds like calculated growth, not just opening the floodgates.
And non-interest income, aside from that one-off gain.
Markets have been very supportive for investment advisory fees, which helps. Other fees, like deposit and card fees, are mostly on track with expectations. Trading revenue, well, that always depends on market swings.
What about expenses? They've cut so much already. Does the cap lift mean costs come down further, or do they reinvest?
Their overall expense forecast hasn't changed, still guiding to around $54.2 billion for 2025. They're still finding efficiencies, like reducing headcount through attrition, but they plan to use those savings to pay for a lot of the investments they want to make. More marketing, hiring more bankers, more financial advisors. Growth costs money.
Right.
And it's crucial to remember, the asset cap is gone, but the underlying consent order that imposed it, still technically in place. They have to be careful changing things until that full order is declared effective and sustainable.
That's a really important distinction. And AI, is that helping with efficiency yet, or is it mostly talk?
They said it's super early, but yes, they are seeing some initial efficiency gains from AI. Across branches, operations, call centers, they expect that impact to grow over time. So it's starting to make a real difference, apparently.
Okay, let's talk capital and returns again. They hit that 15% ROTCE, albeit with a little help. What's the real long-term goal?
Well, they're holding off on setting a specific long-term capital target for now. They're directionally lower because of the SCB drop, but they want more transparency from the Fed on CCRR and final rules first.
And the 15% ROTCE.
They were very clear that's an interim target, not the
Yeah.
final target. They basically said, we're not declaring victory yet, acknowledging the gain helped, but once they consistently hit 15%, the future target will obviously be a higher number, not a lower number.
So aiming higher eventually. And buybacks. That huge $40 billion authorization, is that the top priority now?
Not necessarily the absolute top priority, based on their comments. They have more capacity for buybacks, sure, but they emphasized wanting to use capital first to grow the company organically and support dividend increases.
Yeah.
Buybacks are, in their words, what we're left with.
Interesting phrasing.
Yeah. The goal is to do all those things, growth, dividends, buybacks, to a greater extent than we've been able to do in the past. It really signals that shift towards prioritizing growth investment.
It definitely sounds like they feel they can keep improving efficiency while also finding growth opportunities now. That's the operating leverage story, right?
That's exactly it. They sound confident. They pointed to the $12 billion plus in expenses they've already cut over the last few years, the steady headcount reduction. Combine that discipline with what they see as tremendous amount of opportunity to grow everywhere, that they believe that leads to sustained growth and profitability and returns over the long run. The ship really is charting a new course now.
So wrapping this up, it feels like Wells Fargo isn't just reporting Q2 numbers. They're genuinely sailing into a new chapter. The asset cap lift allows that fundamental shift from remediation, from being constrained, to actually focusing on growth.
Yeah, fueled by that cost discipline they've built and a much clearer runway for using their capital. It's a pretty compelling transformation story for such a huge institution.
It really is. Which leaves us with a thought for you, our listener. As Wells Fargo uses this new flexibility, how does a giant bank like this balance chasing potentially aggressive growth with the constant need for vigilance, for maintaining safety and rebuilding trust after everything they've been through?
And maybe, what could that balancing act look like for the entire financial landscape as this massive ship starts to move more freely again? Something to think about.